The Bank of Canada cut interest rates for a second straight meeting, warning about excess supply now evident in the economy. Also talking about the fact that the unemployment rate has been steadily ticking higher. Let's bring in Paul Beaudry, who's former deputy governor at the Bank of Canada and professor of economics at the University of British Columbia. Paul, thank you so much for joining me. I just get your initial take. Is this where the bank should be right now in this rate cutting process?
Yes, I think it is. I think we had pretty positive news yesterday. On a lot of fronts. The Bank of Canada is really indicating that the factors they were looking to allow them to cut rates are kind of going in the right direction. Inflation is falling within the 3 to 1% band. These are on kind of both the direct measures, the core measures. That's allowing the Bank of Canada to start to continue decreasing rates. So not only have we seen two in a row, I think the tone of yesterday's message said most likely we'll continue to see some decreases over the next several months. At the same time, that doesn't mean that there can't be things that will stop that, but it was actually overall a very positive message for those looking for relief in terms of interest rates.
What do you think happens next? How many rate cuts and where do we settle out?
Okay, the settling out is the big question. The idea that there might be up to 3 rate cuts is a possibility. I'd say at least 2 rate cuts for the rest of the year. So kind of going down to 4% by the end of the year, maybe a bit below. We'll see. Depends a little bit on what's happening elsewhere, for example, in the U.S. also. But it also depends on a lot of the indicators that they've been stressing that are kind of moving in the right direction and really kind of allowing these prices to decrease. Now, after that, after we get into that range of kind of getting into kind of 4 and below, we'll really have to see how the economy is kind of adjusting to that, how much it is picking up, how much the world economy starts picking up as other countries also cut. So Canada's been a bit at the forefront of the rate cutting aspect here. So we'll see that picture. And, it might kind of should fall into the 3s by next year.
We have to talk about this in the context of unemployment as well, because rates might be coming down, inflation getting subdued, but the unemployment rate is moving higher at 6.4%. It's above where it was before the pandemic took hold. How are you thinking about how that evolves?
So that's very important. So now that the conditions for seeing that the price stability is going to come back, that's allowing the Bank of Canada to kind of forecast this part of saying there'll be several rate cuts. They didn't say that explicitly. They just opened the door to that possibility. But it's very much to help the growth pick back up in Canada. And as the growth picks back up, that should help on the unemployment front. Now, notice here, we've had still a lot of job creation in Canada because we've had lots of immigration. So the unemployment reflects that we've kind of not created as many jobs as there's new people coming in. That's why things are ticking. So the groups that have been most hurting by that higher unemployment are young people entering the labor market, some of the new migrants coming in, and higher growth should help that group. And again, if things go to plan and there really is this kind of continuous movement towards the 2% target, this will allow those rates to be cut and help growth in Canada, especially kind of helping in those interest-sensitive sectors like housing that's been kind of, is picking up slowly, and different other sectors, car purchases and the like.
Yesterday, when the decision came down, we spoke with a notable economist, David Rosenberg, who kind of painted a possibly dire situation of how things might unfold from here. I'd like to play that clip and then get your response to that outlook. Here's David Rosenberg yesterday.
Rate's going to go down a lot more, and I think 2%. And I'll tell you what, when we get down to 2%, then you'll have me on the show and we'll talk about it. We're going to go even lower than that.
Really?
Well, because I'll tell you why. Because I
thought we're done with that. We're done with that world. Remember, everybody says that.
Well, we're not going to zero.
Okay.
But let's just put it into a certain perspective here. We have the unemployment rate at 6.4%. It's up 160 basis points from the cycle low. And that hasn't come through job loss, yet. That's come because we have throngs of people coming into the labor market. And in fact, in the past year, fewer than 60% of the people that came into the labor market actually landed a job.
And his point was that in the past, that was 80%. He said there's a scenario where rates come down to 2%, the unemployment rate goes to 8%. Do you see that playing out at all? See us on a path towards that at all, Paul?
I really don't see that as the kind of most likely scenario. The idea that, well, on both fronts, I think those are more unlikely. What we're seeing is kind of this aspect that, yes, there's a lot of people coming in, and you have to compare the aspect of a lot of this is the new immigrants coming in and not finding jobs. We have a lot of variety there, a lot of numbers, so that takes a while. With the growth picking back up, I think unemployment will kind of stick around where it is now and then slowly come back. The rates should come down. The idea that they'd likely move back down to even 2% over at least the shorter term within a year or so is, again, unlikely when you see the kind of growth in the U.S. right now, things picking up and kind of the possibility of large divergence with the U.S. So I really don't see that scenario as very likely. It's not impossible, but it doesn't seem very likely to me.
Well, it's good to get your perspective. I'm glad that you brought up the U.S. because there was kind of a growing call, it seemed, especially yesterday with former New York Fed president saying there should be a rate cut, as soon as possible. And that was kind of an about face, which he sort of admitted. It raised the question, are things about to fall apart in the U.S.? I think that was more concern than maybe reality. But is there a concern that, or a reality that the U.S. rate cutting cycle might not be far off from the Canadian rate cutting cycle?
I don't think the U.S. Rate cutting cycle will be far off. I wouldn't be surprised that by this fall we start seeing rate cuts in the U.S. At the same time, the idea that the U.S. is falling apart, again, the growth figures that just came out for the U.S. show that the U.S. is still growing at a very kind of reasonable rate, much stronger than in Canada. And so they won't be in a huge hurry to kind of decrease, but I would say that they will be kind of coming into this rate cutting cycle very soon. And given that they don't want to see the unemployment rate tick up also and don't feel that's necessary if inflation keeps on coming down, we should see something very parallel to what's happening in Canada.
Can we talk about the currency just quickly? And I know central bankers don't like to do that, but we have seen weakness in the Canadian dollar. At what point does it become problematic in terms of, importing inflation? Is it reflecting kind of this natural order that we've been earlier on rate cuts?
So yes, you're very much like the exchange rate really does tend to kind of be affected by the rate differential between Canada and the U.S. And right now, that's rather, the rate cuts have started in Canada. The Canadian dollar is fluctuating a bit, but it's kind of been rather stable. But we kind of know that divergence can't be very far. So if the U.S. wasn't going to cut at all and the Canada wanted to cut, that starts kind of being a constraint on it. But what's more likely to happen is Canada's going to keep on cutting and the U.S. is going to cut. So that differential shouldn't increase very much. And so the Canadian dollar might be able to stay in the kind of same range that it is right now.